So now I am solving the first problem of MAT. MAT means minimum alternate tax. So herein, for the same firm you have to calculate two different tax. So whichever is high, that you have to pay. So first I will show you how to calculate the net income and how to calculate the tax on that. It is of business. So format is same as usual. You do income from business. So net profit they have given 2,50,000. Next, add inadmissible expenses. So in the P&L account they have given some inadmissible expenses, that is income tax, general reserve, provision for contingent liability, provision for diminution. Diminution means it is a depreciation provision. So that becomes inadmissible. Then proposed dividend, it is not a business expenses. So all this you have to add 2 lakh minus unrelated income. So if you go to P&L account credit side, they have given deferred tax, it is not a business income. So that you have to deduct, and capital gain income, it is other income. So these two you have to deduct 2 lakh. So business income is 2,50,000. In this business income, the any company they will get certain exemptions. Like in ATC you claim insurance, PPF and all RPF. Same way for the company, the Income Tax Act has certain given exemptions. So what is that exemption? Unabsorbed depreciation. In this problem they have given total unabsorbed depreciation, that is 3 lakhs. So here we have business income only 2,50,000. So 2,50,000 you can deduct from business income. So net income becomes nil. Next, capital gain they have given a credit side of the P&L account. So 1 lakh. In that again you have to deduct exemption, that is deduction, brought forward unabsorbed. So capital gain they have given 1 lakh. In that again you can claim the exemption, that is brought forward of unabsorbed depreciation, total 3 lakh. In that 2,50,000 you have claimed here. So remaining 50,000 you can claim under capital gain. Next, brought forward of capital loss, it is they have given in the adjustment. So capital loss can be deducted in capital gain, so that 50,000. So by doing those, so all these exemptions, the total income becomes nil. Net income is also nil, capital gain also nil, so total income nil. So when the total income nil, the firm has to pay tax 25% on total income. So the tax will also become nil. But the central government has given one more method of calculation. Okay, so that is called book profit. In book, first you have to calculate book profit. So how do you calculate? Again the same procedure. Net profit 2,50,000 as it is you have to take. Add inadmissible expenses. This inadmissible expenses you will get it in P&L account debit side. Income tax, general reserve, contingency provision, provision for diminution, all the provision are inadmissible. Proposed dividend 50,000. So 4,50,000 minus here unrelated income you need not have to deduct. Only extraordinary item you have to deduct in book profit. Extraordinary item, deferred tax 1 lakh and brought forward of loss or brought forward of depreciation, whichever is less. So loss is how much? Brought forward of loss, it is 1 lakh. Brought forward of depreciation, it is 80,000. So which is less? 80,000 is less. So deferred tax 1 lakh plus brought forward 80,000. So total 1,80,000. So if you deduct 4,50,000 minus 1,80,000, book profit you will get it 2,70,000. That is the difference. If you see here, net income here it has become nil. but in this case the book profit has 2,70,000. So once you get the book profit, on that you have to pay only 15% of tax. On net income, total income, you have to pay 25% tax. On book profit you have to pay only 15% of tax. So 15% of book profit is 40,500 plus education cess 4%. 4% of 40,500 is 1,260. 1,260. 1,620. So total amount becomes 42,120. So here on book profit you are supposed to pay 42,120 tax. On net income the tax amount is nil. So whichever is high they will consider that one. So whichever is high, the here high amount is 42,120. So that amount is taxable amount for the firm.